we talked about the pension transfer. The transfer is transferring the responsibility to insurance companies who now bear the responsibility, because obviously nothing bad can happen to insurance companies. And we started talking about this then, that it's not just the banks that are strained and loaded with assets that have, I guess you could say, become toxic. Assets that were always considered safe and reliable are no longer such, as interest rates are rising again. And the insurance companies and the banks had bet that that wouldn't happen again, but yet it is happening again. The insurance companies are loaded with treasuries. That's how they in their mind, are able to guarantee a good portion of their obligations. It's not the only thing they're invested in, but a large portion of what they are invested in would be treasuries, would be things that could certainly have a similar effect in terms of problems in a rising interest rate environment that the banks have. And when we talk about what's happening in California, you know, my heart goes out to all the folks there, and it's hit close to home because one of our own, Dunnigan, Megan, my assistant, their family lost their home, completely, totally gone in Palisades. And listening to someone who's actually going through it is heart-wrenching. But this is no small deal. This is, when you talk inflation-adjusted dollars, this is 60% more than the most expensive wildfire in history, at least as of right now. The insurance companies are on the hook for well over $20 billion in damages. And this is exactly the kind of event, the unforeseen event, that can very quickly change the narrative as it pertains to the health of these insurance companies and the health of the reinsurance companies who are backing them up. We're already seeing massive strain on the stock values and the book values of these insurance companies just overnight. Many of the insurance companies saw this coming and bailed. State Farm, I think it was 1,600 policies they did not renew as of July in California because they saw this coming. This is a massive strain that could very, very quickly become something much bigger, as the amount of money that they're going to have to come up with is extraordinary. And this could change not only their books, but the reinsurance books and the banks that they all do business with. This is the kind of event that strains the system. And then they have something, I forgot the name of it. Let me see what the name of it, I think it's called. The point of it is, what I'm really trying to get across is, and it's something like California Real or something along those lines. The commissioner of this program a year ago went in front of the legislature and said that this community pooled insurance program for those folks in high-risk areas like Palisades who couldn't get insurance because of fire risk is woefully capitalized and has great exposure to risk. This is exactly what she's talking about. So not only are the private insurance companies in big trouble, now you have the government-sponsored programs that are in trouble in a state that is massively underwater. Where does the money come from? And this is a growing problem. God forbid there's another problem that pops up out of nowhere, and then things start to become exponentially more difficult. The people who are thinking rates will never go higher, this is the biggest ever move higher in yields following the first Fed cut ever. And so it's moving counterintuitively to history. It's moving counterintuitively to the Fed's wishes by lowering the front end of the curve. The back end is going up. We were also talking, Mario and I, about what's happening in the UK regarding yields, and he was saying the bond yields on the 10-year, 30-year, what, 5.6, 5.7?
Yeah, almost, and it's at the highest level since 1998.
Right, and so this is not just the United States. This is happening to our allies across the pond. Higher rates is a consequence of all the money creation, of monetary and fiscal irresponsibility, and there's no way around that, which will just add strain to the already over-leveraged, undercapitalized insurance industry and banking industry. And this is something that I think will become a major focus of anyone running a business or trying to figure out the cost of money. It has to move higher on the back end of the curve, and that is the part of the market that all of the loans and the leases and the mortgages and the credit cards, all of the important things are based off of, not the federal funds rate. You know, reset the system because it's so indebted, and as rates rise, the ability to maintain that debt becomes much, much, much harder And that's the point. Since 1982, rates have fallen at a 45-degree angle. Everyone thinks that that's just part of the way things go. Falling rates make asset prices higher, and it's moving in the other direction. And the issue is that it's so many businesses and people in general who are trying to calculate their risk and their ability to maintain and service their debt, expect interest rates to continue to fall, but they're going in the other direction. And that would be the catalyst really to blow up the system. And you put that in context with the way the psyche of the investor. Last week, Tuesday, was the record. Tuesday was the record trading day in the United States, all-time record for stocks trading under $1. Those are penny stocks. That is associated with speculative mania. And when you put that together with the Trump euphoria, with everyone thinks that everything is just going to get better, and in some degrees, in some respects, it will. But to ignore the financial implications of where we are, how we got here and how we get out of here, and what that looks like, writing that off to this exuberance is going to be, in my mind, a massive mistake. And this is the kind of thing that can very quickly change the narrative. And not to mention, I don't know how many people think that if he really is President Trump fighting the deep state, are they just going to lie down and let this go? Or do they attempt to make things very challenging for him within an economy that is so fragile, it just takes but a flick maybe to cascade things down the hill. And I don't want to go into this realm of conspiracy, but for people to think that this will just be smooth sailing, I think is foolhardy. We've had some very large deals recently, really large, but missing is the volume. It's interesting, Dunnigan, because all we continue to hear is strains within the LBMA and the COMEX. Huge deliveries, 46 million ounces delivered of silver off of COMEX in December. Huge deliveries off the LBMA and all of the exchanges around the globe. The central banks doubling down their 12-month moving average the last 2 months of 2024. And at the same time, I would say that the retail demand is eerily quiet. Premiums on gold and silver coins that were parabolic during the pandemic have fallen to levels I've never seen before. Much like a pendulum shifts from one side too high to the other side too low, that's where we are right now. The biggest, most sophisticated, well-informed money on the planet is doubling down their acquisition of gold. And the people in this country, largely, if I had to, kind of just paint a narrative, it would be that they are swept up in the euphoria after 4 years of living in a world that no one really recognized. And I understand it from a basic level. I get it. But I think it's a big mistake, and it's setting people up in disaster. I mean, we can just simply say there are three groups right now, three pools where the majority of the money is. One, money markets, over $7 trillion, which typically is associated with a recession, on top of all of the recession triggers that we've seen, the Somme rule and the uninversion of the yield curve and all of these things. Number two, 7 stocks, the Russell 2000 and the Wilshire 5000, which is a much better picture, snapshot of the United States economy. The majority of those are underwater. 7 stocks holding the whole thing up. That's where the majority of the money is. And then in cryptocurrencies. And the cryptocurrency market, in particular, Bitcoin, has been so financialized. Thinking again in terms of a rug pull. One big bank falls, one big bank, like a Bank of America. You keep hearing rumors of it, a bank bail-in. Things get very real, very, very fast, as it would sweep up in one swoop a good portion of all three of these markets: the crypto market, the 7 stocks, and this money market phase where even though they changed gating legislation, they can now impose serious fines, if you will, or costs for making them really uneconomical to leave the money market if people start to do that. It's the same thing as gating, only you can leave, but at a very high price. So I'm not, again, trying to walk the line of conspiracy and reality, but when you talk about how bad this could get very quickly, it's very fragile. And I think that's the one thing people are missing. It's very, very fragile right now. And I think the stage is set for something to happen that would very quickly wake up the entire country, which would very quickly reignite the demand for physical precious metals, like we saw last March and April when the banks failed Silicon and Signature, where we added 14,000 clients in 45 days. That's 4 years worth of client acquisition. And those banks were illegally bailed out. Remember what happened in Lindsay, Oklahoma in October, the first bank bail-in. Was that a test flare, if you will? Was that a trial balloon for a bigger, more significant bank failure, which would usher in what? I guess that remains to be seen. But yeah, I think that the people are missing entirely. It's funny because at the same time, all of the people are missing, the most well-informed traders in the world are doubling down. This is the one thing that I think kind of slaps me in the face. And I'll be one of the only people saying this over and over. But yeah, but you own a gold company. I don't care. I mean, the truth of it is, that is what's happening. Biggest money in the world doubling down on gold, not on cryptocurrency, not on money markets, and not on the Magnificent Seven. At the same time, that's exactly where the people in this country are, thinking that rates could never go higher, things can never get worse, we can never see a bank or insurance company failure until we do.